Hello, and welcome to episode 27 of
Mo Money,
the Investing Show for Millennials by a Millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, the one and only host of the show, MC Mo. We have a special episode for you this week. We have another
Mo Money Face-Off.
Now, one of the questions everybody asks when we first start talking about investing is, what do I buy? And I always tell them, just buy what they know. But what do you do if you know absolutely nothing? Well, luckily for you, Wall Street has created products for those who know absolutely nothing about investing or business in general and are too lazy to make an attempt to know anything at all. These products are called mutual funds and ETFs, and this week we'll be comparing your parents' old boring mutual funds to the new, exciting, and arguably much better and much cooler ETFs. It's vinyl versus stream. It's encyclopedia versus Wikipedia. It's the VW van versus the Tesla Model X. It's the Beatles versus Kanye West. It's John and Jackie Kennedy versus Sean and Beyonce Carter and Knowles. It's Sean Connery versus Daniel Craig. I could go on, but you're getting my point. In the words of Barney Stinson, new is always better. Now, we've all heard of mutual funds. They're those boring investments that your parents and probably grandparents put a little bit of their paycheck in every month for retirement. If you're not familiar with mutual funds, here's how they work. First, you have large companies like Fidelity, Vanguard, Capital, or JP Morgan who pull a bunch of investors' money and put it into a fund. In return, the company divides up the fund and returns shares in the fund to the investors. The fund is controlled by the fund manager who makes investment decisions on behalf of the investors. It's basically like being a part of a hedge fund without the millions and millions of dollars it takes to invest in a hedge fund. Seriously, $100,000 won't even get you within a mile of most hedge funds. So professional management and expertise without needing large minimum investments is what mutual funds do. Now, most of these funds have some type of theme that is supposed to make them unique, interesting, and summarize their whole strategy. So a few made-up examples, similar to what you may find is Fidelity Growth would be a mutual fund designed to invest in the best growth stocks. Or Vanguard Total Bond Market would be designed to invest in a large group of bonds within the bond market. And so on and so on. Now, the managers of mutual funds are supposed experts in the fields and are attempting to put your money where their mouth is. And they'll buy or sell whatever, whenever they need to prove their superiority. Thus, most mutual funds are actively managed, meaning they are constantly buying and selling stocks, not buying and holding. Now, these mutual funds all use some type of benchmark to compare their performance against. So some might perform against the S&P 500 or the Dow Jones or even competitors' funds of similar strategies. Take me, for instance. My benchmark would be like Mad Money, that Fox on Stocks chick, or some old dude on financial TV trying to be hip telling millennials how to invest. In my opinion, I'm strongly outperforming all of them. So that's what mutual funds are. Now we get to the ETFs, the cool modern investment vehicle. If mutual funds are the Ford Model T, then ETFs are the Tesla Model S. I don't know shit about cars, so insert whatever cool car you like, that's an ETF. Now, ETF is short for exchange traded funds, so they trade like stocks. But what are they exactly? Well, remember when I told you mutual funds attempt to outperform a certain benchmark? Well, what's if I told you that sometimes mutual fund does not outperform that benchmark? Not saying that you lose money, but your mutual fund manager does not do as well as that benchmark. Well, you'd probably just want to leave and go find a manager who can beat that benchmark. But the thing is, it's hit or miss. Even the best and smartest manager, even if you went to Harvard or MIT, even those guys are going to have a bad year or 3 years and then some great years. Well, that's where ETFs come in. They don't attempt to beat a benchmark. They attempt to replicate perfectly a benchmark. And how can they do that? By owning all the stocks within that benchmark. So it works like this. An ETF sponsor like iShares, Spider, or Vanguard will go to an authorized purchaser. I'll call them AP for short. It's usually one of the big banks with an idea for a new ETF. The AP will put up seed money and go out and buy the components of whatever that index or commodity or whatever they're looking to track is. So take SPY, for example, an ETF that tracks the S&P 500. Spider, the ETF sponsor, holds all the stocks of the S&P 500 and returns shares of the fund to the AP, and they in turn then go sell them to investors. Or take GLD, an ETF that tracks the price of gold. Spider, the ETF sponsor, holds physical bars of gold. Or even ICOL, iShares ETF that tracks the Colombian stock market. iShares owns a portion of all the stocks within that market. That's what makes these things so great. In a world of Wall Street gurus and geniuses, there is a product that just plays it safe for the most part and just plays the averages. At some point, these ETFs can begin to trade at a premium, which means more or a discount less than the equilibrium price, aka whatever the price of the index is actually at. Does that sound confusing? Let's put it this way. It's like this. If the S&P 500 is trading at 2,100 basis points, then the SPY ETF should be trading at $210 a share. But sometimes high demand or high selling pressure pushes the price of the ETF away from its equilibrium. The same way a stock is affected by increased buying or selling. In that case, the AP's job is to buy or sell the ETF to get it back to its equilibrium. The reason I tell you this is it's important to know that these ETFs will almost always be trading at their NAV, their net asset value, which is whatever the index is. So which one is better for you? Well, by the way I started this whole episode, you may think I'm immediately going to just disqualify mutual fund, but in truth, although old-fashioned, they do have a lot of benefits, and ETFs, although cool and new, still have some downsides. So let's get started with
The Mo Money Showdown.
the fight of the funds, mutual funds versus ETFs. The first round is fees. Mutual funds charge higher fees for a number of reasons. First, the mutual fund managers, being the genius expert that he is, charges a fee for his services. On top of that, there's also fees for the active investment approach. The frequent buying and selling of shares for the fund costs money to the investors. So with mutual funds, expense ratios can be anywhere between 1 to 2%, and that's a fee that you must pay, even if the fund underperforms or even loses you money. Now, ETFs don't have this problem because most of them are managed passively, meaning they never sell shares within the fund, meaning less transaction costs for shareholders. The average expense ratio of an ETF is about 0.44%. Obviously, ETFs win this round. Second round, tax efficiency. Mutual funds are generally seen to be very tax inefficient investments. The reason being, when somebody wants to redeem their shares with a mutual fund, the mutual fund must go out and sell stocks to pay back the investor. They sell stocks that are winners, the fund will realize a capital gains tax that shareholders will be responsible for paying. So anytime a mutual fund sells stocks at a price higher than what they were bought for, they'll be responsible for taxes. Even if the fund loses money in a year, you may be responsible for taxes on some of the winners that were sold within that year. ETFs are more tax efficient because they're passively managed, so shareholders are shielded from capital gains taxes while holding it. So if you're worried about taxes, which you should be because they suck, ETFs are the clear winner in this round. Next is round 3, minimums. Mutual funds require minimum investments, meaning that you have to have anywhere between $3,000 to $5,000 to $10,000 just to make an initial investment within the fund. Some offer minimums for $500, but for most investors, especially for millennials, minimums that high can be hard to meet. ETFs, since they trade like stocks, they have no minimum. If an ETF is trading for $10 a share, you can invest $100 and buy 10 shares. At the same time, because of commissions, it may be a good idea to save up $1,000 and then invest it all at once to save yourself from high commission costs. But ETFs are the winner here, okay? They are more accessible to your young or new retail investor due to their no minimum investment ability. Round 4, options of investments. Mutual funds are typically known for being fairly focused in the few investments. You have your equity funds, fixed income funds, and balanced funds. But now with an increase in popularity of ETFs, mutual funds have begun to attempt to capitalize on the success in many different fashions. ETFs, as we stated previously, have a wide array of different investments. Broad-based indexes, sector indexes, commodities, fixed income, real estate, foreign or domestic, specialty, pretty much any theme, there is an ETF that has that investment strategy. But I'm going to have to chalk this round up as a tie. Both investments now offer a pretty good range of different investment capabilities, whether it's an ETF or a mutual fund. Round 5, performance. When a person makes the choice of safety in their investment strategy, they do so at the expense of returns. ETFs tracking indexes for the most part will yield smaller returns than those of mutual funds, but at the same time, they're less likely to lose money than a mutual fund manager on a stock-picking losing streak. For instance, the S&P 500 is up over 200% in 20 years. Now, if you bought an index fund then and came back 20 years later, found out your money had increased 200%, you're going to be really fucking happy. But then as you're cashing out, you look to your right and you see your dickhead, always positive, always way too fucking happy and friendly neighbor Greg there. He invested in VHCOX, a Vanguard mutual fund that is up 500% in 20 years. Now you move to Florida and end up living right next door to Greg again because your wives are fucking best friends, and Greg is living in a fucking Gatsby style mansion while you're living in a fucking Nick Carraway looking style shack because you played it safe. So the winner of this round is, again, it's a tie. Depends on what type of investor that you want to be. You want to be a risk taker or you want to play it safe? The choice is yours. Bottom line, the obvious winner in the fight of the funds was ETFs. They are for the most part the better option for investors, especially most millennial investors. They are low fee, no minimum, tax efficient, generally safe investments. You take your first $2,000 you saved up and you park in an S&P 500 index fund, you're gonna be all set. It's a great cornerstone for a young portfolio. Once you have it, you can add to it, then begin to buy other things like individual common stocks or foreign market ETFs. Mutual funds, like I said, obviously have some great benefits, but at any type of return that you're looking for from a mutual fund can easily be matched or outperformed if you pick the right stock. All it takes is a little discipline and patience. So if you truly do not know what to invest in, go with a nice broad-based index fund ETF. Buy it and forget about it. Study up a little bit about investing, watch some more of my videos, and if you feel that you can do better than that ETF, start buying some stocks. But if not, you'll be happy with the steady returns. A lot happier than the return your money would be getting from a bond or a bank account or sitting under your mattress. Trust me. Thank you so much for watching another episode of Mo Money. Now that I'm back, you know we'll be here every week with a new episode episode. For now, don't forget to like, comment, subscribe, and share. Follow me on Twitter and Instagram. Like me on Facebook. Mo Money.
Signing now.